We have a very interesting topic today. Is definitely global financing stuff. And not only that, we'll hear more about the paper, but the presenter is our old network contact, old friends, long historical friends. So I actually met Issouf through AERC, African Economic Research Consortium. We met in Nairobi for a few times regularly. And I still remember, Issouf, you did your breakthrough book launch at SOAS some years ago. Exactly. And that was foreign direct investment. So let me introduce a little bit more. Issouf is now a professor of finance and the director of the laboratory for financial engineering at Université Laval in Canada. And I can see Issouf, the research and teaching interest is very much but focusing on international finance, financial inclusion, financial development, financial system. I remember, and risk management, financial engineering, etc., etc. So I will skip the activities, other professional activities that Issouf, but in summary, Issouf is engaged with the practitioner, the practice with the industry, with some organizations, and as you can see, he is heavily involved in those other professional related activities. But academically, Issouf published quite a few papers in good journals. I'm not going to go through them, but I remembered something. But Issouf highlighted some books that he authored and he co-authored with other colleagues. And as you can see that, they are with good publishers. We are now working on another project together. So, Issouf, I think it is more important for us to hear from you about the research, the very relevant and interesting topic. And you do not mind if we have some questions, we can always exchange questions and you can always respond to the questions.
Absolutely.
Yeah, okay. Issouf, good to have you. The floor is yours.
Yeah, thank you very much, Ong. Thank you very much, Meng. Always a great pleasure to see you. And thanks a lot for this generous introduction, actually. I just want to mention that Désiré Kanga, who has been at SOAS, I think he's a fellow for SOAS. He has been there, for a couple of years, if I'm not mistaken. And then he's one of the co-authors of this paper as well, right? And then at the same time, if you have any technical question, probably, Désiré will be better place to answer those technical questions even than me. Okay, then this topic actually is really interesting, as you said, man. I completely agree with you. It's on microfinance. Unfortunately, Hubert Tchakoute, who is really a expert in microfinance, is not here today. I think, yesterday he got something, actually last minute, and then he couldn't make it, actually. And then he apologized for that, actually. Okay. Then this paper is about related lending and loan repayment performance in in microfinance, actually, which is a social finance sector. And then basically what we look at in this paper is whether related lending, which I will define related lending soon, whether related lending actually has any impact on the loan portfolio performance of microfinance institutions. Right, this is the main question we are looking at, and whether having more female loan officer in charge of those type of loans can kind of mitigate some of those negative externalities. That's really what we are looking for in this paper, actually. Okay, then what's related lending? I mean, to be sure that we all understand, I mean, the same way. Related lending is, I mean, can you see I'm on my second slide. Can you see that, right?
Yes.
Okay, good.
Yes.
Yeah. Okay, then the related lending refers to credit extending to individuals or entities close who are very close to the institution, the microfinance institution in our case here. For example, shareholders, the managers, the boards, members, the executives, the relatives, or the affiliate companies, right? When you do this kind of loans, we call it, I mean, a related party lending. Okay. And this type of lending, I mean, the issue related to that it has been studied. I mean, it's not like something new, especially on the conventional banking institutions. I mean, there have been many studies on that. For example, you see, for example, the Chatham in 2023, for example, found that related lending in the banking sector I mean, result in significant financial losses and have affected public confidence in countries like Bulgaria, Ghana, Iceland, Moldova, Portugal, and Ukraine, actually. Well, and then there have been many studies on these topics, but as I say, in the banking sector. But despite this, this huge amount of studies being done on this, well, it has received very little attention in the financial institution like microfinance institution. And this is really the focus of our work. We want to look at really this issue on the microfinance in the microfinance area. Okay. Well, and why is that? Because if you look at microfinance institution, most of the time, microfinance will combine two logic, right? I mean, the financial logic, because they have to be sustainable over the time, then they have to be able actually to be sustainable, especially profit-oriented microfinance institutions, right? And at the same time, they have this kind of social logic. The social logic is basically because they have to serve much more the poor, people in the remote areas, and so on. Then they are trying to combine these two aspects, okay, or these two logic, I mean, the microfinance institutions. Well, but at the same time, I mean, combining these two logics, well, then you can see, then the related lending, if you take in on the social logic perspective, then we can say maybe it's good because it's expanding loans to some segment of the population, some type of firms, even if those segments of the population or those firms are closely tied to them actually. But at the same time, if you look at the financial logic, you can say, well, if they do too much related lending and then the portfolio become vulnerable, then the sustainability over the long run will be even questionable, right? I mean, then you look at these two actually. Then these two tensions, I mean, actually kind of exist in the microfinance. Well, then based on that, what do we do actually, right? Then for us is really, we will really examine the effect of related party lending on the loan portfolio quality of those institutions. And then we'll look at also if the loan officers who are in charge of monitoring those loans, if those loan officers are females, does that actually has any mitigating impact actually on this kind of on the impact of this kind of lending, actually. That's really what we'll be looking at. And then we use the mix platform, I mean database actually to address this question. I mean, this is what we are doing. Well, in terms of contribution, then if you have to leave or if you don't follow me until the end, basically we look at mainly two theoretical perspectives as well in terms of really related lending and portfolio quality. And then we also, at the gender part, we look at one gender hypothesis. Well, those two, I mean, competing theoretical perspective are the looting and then the information perspective. Then the looting perspective will tell you that basically related lending is bad, because actually it will kind of exacerbate, agency conflict within the institution. And then this is not good actually for the institutions. On the other end, the information perspective tells you that, well, because those people who are benefiting from related lending, since they are very close to the institutions, then it's much easier for the institution to recover actually to have the payment. then because we have better information on those people and so on, so on, then, well, it may be that it will improve instead actually the loan repayment and so on. Then you see, then one is positive, the other one is negative actually. And then we build our hypothesis based on these two, these two perspectives. And then beside that, there is the gender effect hypothesis, right? I don't know why the screen is still on changing. Probably I have something, linked to my programmation. Okay, then the gender effect hypothesis say that, well, the female loan officers in monitoring can be more effective than male officers. I will motivate that later on with literature review. Well, then you see, based on this one, well, we use our data and then we build on two hypotheses. The first one is the first hypothesis. We are building on is basically related lending has a negative impact on the portfolio quality. That's our first hypothesis. And our second hypothesis is basically when the institution has a lot of more female loan officers, then this has kind of mitigating impact. It mitigates the negative impact of related lending on the portfolio quality. This is our second hypothesis we are trying to test here. And then to test that, we use the data, as I say, we use the microfinance information exchange database. And then it has a lot of microfinance institutions, and then we use it, we sample from 2004 to 2018, actually, this period, actually. Because after 2000, at some point of time, then this database kind of stop, actually. And then basically what we find is related lending indeed actually has a negative impact on the portfolio quality. It kind of degrades, actually. It kind of, has a negative impact. It means that on the portfolio quality, we measure portfolio quality with a portfolio, at risk at 30 days. Okay. And at the same time, when we look at actually the impact of a loan officer's gender, right? The female loan officer seems to be mitigating this impact, especially that if they reach a certain critical mass level, actually. And then for us, it will be that if you are more than 53% of the loan officer who are female, then that has really a mitigating impact on of this. It mitigates the negative impact of this related lending on portfolio quality. Then basically, this is what we are doing, all right? Simple one we are doing. And then we do a lot of, because there are endogeneity issues related to this and so on, then we use a lot of techniques actually try to actually address some of those endogeneity issues, to address some of those selection bias issues, actually. Okay. Yeah. But this is the main contribution. Yeah, yes, go ahead, Min. Yeah. Mm-hmm.
Yeah. So I'm thinking about the concept of this related party lending. I do firm level related party transactions. So I know when the firms are lending to the related parties, it means they lend to some businesses rather than individual people or a person. So in your case, I think I'm not sure whether this is called the related party lending. You can say related lending or relationship lending, but I'm not so sure, but maybe you can call that. But can you distinguish, can you clarify whether your related lending refers to lending to the business that connected with the microfinance organization or individual people that are connected to people who are involved in microfinance providers?
Yeah, okay. No, that's a good question. In our case, it will be both actually, right? It will be to companies which are very close to them, or which are owned by people who are connected to them. It will be also lending to people actually, because you see, we are talking about microfinance, and then on the people who are served by microfinance, you have many individuals, entrepreneurs as well, right? Because don't forget your informality and so on. Then many of the clients actually are informal people, are individual entrepreneurs and so on. Then sometimes it's very difficult to make a difference between the companies and the individuals actually. That's why, our definition of breadth is much larger. It will be really lending to people who are connected to the microfinance or companies connected to the microfinance institutions. Both, we include both of them, inside here. But I think, I don't think we are able to differentiate between firms and individuals. But I have to go back and check, the database. Maybe Désiré can clarify that, but we really combine all of them, actually. And then this is what we call a related lending, actually.
Yeah. So the reason why I asked this is because I think the impact will be different between businesses or individual people. So, but we can discuss more. I see Désiré, you know more, right? So come in, please.
Exactly. Yeah, go ahead, Désiré.
Thank you so much. Good afternoon, everyone.
Good
So
afternoon.
just to clarify that our database is MFI balance sheet, not loan level data. So therefore, what you are saying is very interesting, but we are not able really to distinguish if it's company related to MFEs or actually people that are inside the loan, because we are using balance sheet data. So the question is open: is it very important in that case if we use balance sheet data instead of loan level data, because we don't have loan level data to try to distinguish what you are saying? Thank you.
Mm-hmm. Okay, so you do this from standing in the shoes of the microfinance organization.
Correct.
Yeah. Okay. So continue, please, and let's see. Interesting.
Okay. Okay, thank you very much. Okay. Then basically this is what we are doing. Then I'm telling you the contribution. Then anyone has to leave and so on, but this is the main message of our paper. Well, then let's go through the literature review first before I come back to exactly our model and then also the result and so on. Okay. Well, as I said, we examine the sensitivity or sensitivity of the MFI loan portfolio quality to amount of related lending actually we engage into. And then, as I said, we examine two competing, theoretical perspectives. The first one is the looting perspective. Then the looting views, actually related lending as really bad, as pernicious, because from this perspective, it amplifies agency conflict within lending institutions, and this has been, lauded by some authors actually. And then, according to this view, the related lending will incentivize, actually, insider borrowers, to expropriate cash and then asset from external investors to benefit for their own benefit or the benefit of their firms, actually. Okay. Then, if we go on this perspective, that means that we can expect insider lending to increase the vulnerability of microfinance institutions, because basically you are not giving to them the money because they are good, but because there are some agency issues, then you give them money even if they are not good borrowers. And then at the end of the day, this should really increase the vulnerability of your portfolio because it increases the risk of your portfolio, actually. The second one view is known as the informational perspective, right? Which actually will predict instead the positive effect of related lending on the performance and risk. Basically, the idea is that because those insider borrowers, they are very close to the institutions, then you have valuable information on them. Then you can really know who they are and so on, the capability of being able to pay and so on. And also, this related lending also can be used as a mechanism to incentivize, also reward those insiders at the same time, and then to align also the interests with those of institutions. If we take into, this perspective, this is the argument of this perspective. Okay. And then basically, if you take it, as I said, in microfinance, the type of real clientele is very different from the traditional banks, actually. Well, then you see that the related lending can be part of a dynamic incentivize where access to loans actually in the future also depend on the way you repay it. And because these people are insiders, then you can see they can have some good behavior actually in the way actually they will be paying their loans to get access to future loans. And then this has been also stressed by some of the authors actually. Okay. Then basically, if we go on this direction, that means that close ties with institutions right, will have really be good for the repayment of loan, and then it will really improve the quality of the loan portfolio. This is from this perspective. Then you see these two perspectives have completely different ways of seeing related lending. Okay, but all based on these two, we actually, our hypothesis will be based on the first perspective, whereby we actually posit that related lending will increase the riskiness of the MFI loan portfolio, right? And then we weaken, loan repayment performance. And why, did we took that thing? Because basically, those MFIs will operate mostly on weak governance environment and so on. Then enforceability of the contract and so on are very weak actually. Then we do believe that actually there will be a lot of abuses actually with those related lending. And the outcome will be much more negative impact on the loan portfolio performance than a positive impact on the performance actually. That's really basically, the first hypothesis will be tested. And then because this contract actually related lending, these are incomplete loan contracts actually by nature, then they need to be really monitored actually to be sure that the performance of the portfolio is not affected actually. Then the monitoring for us will be done by loan officers, right? The loan officer will be responsible for monitoring those loans actually. We need actually to understand the characteristic actually of those loan officers to see that the characteristic of those loan officers have any impact on the performance of those loans actually. This is really, and of course, if you look at the literature on in the microfinance and also in the banking literature, there has been a lot of papers on really the loan officer gender, on the outcomes, loan outcomes. There have been many papers on that, whether being a female is much better than being a male and so on, and vice versa actually. There has been a lot of work on that one, okay? And then, for example, if you look at, we have this author, Blanco, Olivier, and all, who actually report that loan write-offs will increase in microfinance institutions with higher female representation among loan officers. But however, they also report that the write-off will decrease when female loan officers are paired with female borrowers. That suggests that gender-based affinity may kind of enhance monitoring effectiveness. And then OTT and in all, they found that female loan officers are generally more effective than their male counterparts at promoting, actually, loan repayment, actually. And then Beck and all also add that female loan officers may encourage better repayment outcome and by fostering strong trust-based relationship with borrower than male, loan officer, okay? Well, and as also, if you look at research on corporate finance also, that one also suggests that women are more honest, right? Less overconfident and more risk-averse than men, actually. Then based on that, there have been also papers who found different type of results. Like, for example, Vandenberg and Tchakoute, Tchuigoua, they found that the completely opposite result. But their study were much more on NGOs, microfinance institutions, actually. Okay? Based on that, okay, and then continue why, actually we think that we should take the perspective on the women one. If you look at, the paper by Lara and all in 2017, they found that, okay, basically, women most of the time face barriers in attaining decision-making roles, actually. Then in microfinance institution, it means that to really go up to the level, it's much more difficult for women than for men, actually. Well, then, the women actually who achieve that, who are successful in those organizations, they have to show that really they actually show much higher performance standard than the men actually, because people judge them very severely compared to the men counterparts actually, okay? Then they have to demonstrate that they are competent, their integrity and so on. Then when they monitor sensitive loans like that, well, there are pressure, right? Because pressures are coming from, related, because when we talk about related party lending, it can be your manager, right? Your manager of a firms or someone close to your manager who's coming to borrow. And then if you refuse it, there can be career concern and so on. right? And then there are some argument to say that, well, even their career concern for those women also, because sometimes it's very hard for them to reach the top level, and then people really, closely look at them. Sometimes they will really stick to the value actually, and then then in terms of monitoring, there will be much more monitoring, much better than than the men actually, right? Okay, and then also to finish on this, well, then also studies found that on average, women are more risk averse. Yes.
We have
okay.
a hand.
Yeah, we just
Shall we
finish on
allow
this
a
one.
question?
Yeah, we just
Yana.
yeah.
Oh, I mean,
Yeah.
I mean, is the you can speaker can finish if the word, but I had a question actually
Okay.
to just sort of from the beginning that now I mean just in case I cannot be continue to do your presentation.
Okay.
Its topic is very interesting. I really love it because I also studied partially on the concept. But I was wondering, I also asked you a couple of questions about the data.
Mhm.
We are talking about the loan officer, female loan officer.
Mhm.
But how about maybe if they are independent, make their decision? I fully agree with you. They are better managers, and they are more, at least on the issue about loan and other things. They said, but what about is the institutional manager or managers or division manager or about shareholder who is or board? This I know these are very small institution, so it could be the loan officer could be the same as the division manager as well. So I was wondering, have you thought about it? Have you bring up this if the manager male and then how the female loan officer decision is the affected?
Yeah, understand. So, do you want to respond, Joseph?
Yeah, well, yeah. Then you mean that inside if there's let me tell me if I'm correct actually. You mean in the decision taking process, you wanna know that if the females really they're independent in the decision taking. Is it that right?
Yeah, it's a more yes.
Yeah, exactly right. Yeah. Okay. Of course, we don't have that specific information to know if they are independent in their decision taking. I agree with you, of course, because basically it's not because just you have female loan officers, then it makes a really big deal. Because if they are not independent, then of course it won't change much actually. I completely agree with you. But we don't have those specific, really information really on those ones. Because you see, we have this cross-sectional, microfinance, information, and then based on the balance sheet and based on the information that basically are there, female loan officer, the percent of female loan officer, the number of female loan officer, but we don't have those specific information. I agree with you completely. And then probably this is one of the weakness of the paper as well. Yeah.
Is if you didn't have it, which is okay. What about the board board information or percentage of the board in the female? That could be also a good indicator. Not the best one, but it's a good indicator for you to have the sort of to see the impact on the male or female superiors.
Right. Yeah.
So I thought, you see, the topic is so interesting.
Exactly.
I see the hand from Tulu. And then we have another hand. I like interactions, to be honest. I do not mind. So, Tulu, you have a question?
I think to some extent my question has been addressed. I wanted to ask if you were using aggregate numbers from the balance sheet, how were you able to match the female loan officers with the specific loans? But I now came to realize that you use the percentage of female loan officers.
Exactly. Yeah.
Instead of the individual loan officers.
Exactly, right. Yeah, exactly. You know, yeah, it's not like we don't match. I mean, the loan by loan. Actually, we take the percentage. How much percentage of a loan in the microfinance institution, for example, is giving us related lending, and also we look at in the microfinance institution what percentage of the loan officers are female actually, aggregate one actually, but we don't do matching by matching actually. Yeah.
Okay. Now I understand the data.
Yeah.
Thank you.
Exactly right. Yeah. Désiré has his end. Désiré, you want to add something? Yeah.
Yeah, Désiré, yeah. Who wants to take the ownership? Let's have more.
No. Yeah. I mean, the comment are so interesting that I just wanted to know more and how to improve the paper. So what you said. Actually, in the implementation, we did we said two steps. So the first step is that we use female officer. We use as a binary. If the microfinance institution has one or more female officer, will be 1, otherwise will be 0. So, and after that, we use the percentage, as Tulo said, the percentage of female loan officer in the microfinance institution. So, are you saying that because we also have the number of boards, we can members, we can have the percentage of female that are part of the boards. So you think that we should control for the number or proportion of female at the board, or we use it as instruments in the female estimation. So the first thing will be proportion female. We add the number of board member, and next stage we will use that to kind of see the impact on the MFE and the.
And I actually want to add something in addition to Yana's point. I think the point is not really whether or not they are women, loan officer. Maybe they play an important role because, yes, I have a boss who told me to do something, but in the process of doing this, I have my own personality, I have my own skills. So I maybe I'm influencing the process. So that helps. But the problem is you need to distinguish between the two theories. If you check the women officers who are operating, then you have a different theory, psychology, sociology. But if you use the board gender diversity, you have the corporate governance theory. So diversity, gender diversity is a corporate governance mechanism. So that's the traditional corporate governance. So I see you can do both, but they are not from the same theory. So, but I can see, Joseph, your question is on the corporate governance side. So you want to tackle the corporate governance issues rather than another theory, and that is, to me, information asymmetry theory is also relevant. I lend to my siblings I trust more than I lend to an outsider, somebody. So what about this impact? This has to be positive, right? So I think there are two theories you need to distinguish why you choose to do CD governance rather than information asymmetry. And then that is related to what kind of women structure that you are looking at. So I prefer to see women officers more than corporate governance because I think this has more room to make stories more interesting. And psychology, and things, if you can match people. But I probably do not know whether you have the information. But that's my understanding of those questions.
Yeah, but I think also one of the things, I mean, when Ian was talking about looking at the board, it was because, I mean, I guess, I mean, the idea behind it probably can explain it much better because he was talking about the independence of women. Then probably he has in mind that if there are more women on the board, that can empower much more the women's loan officers. I mean, this is basically that was my understanding of it. Yeah, probably it was that your.
Yes, I think I am more looking at the immediate the data itself, and then if the CEO is female, then I'm expecting the CEO is have a own personalities to affect the institutions. So if the CEO is the female loan officer, whatever the way, how do you measure it is looks like a bit question for me. But if the loan officer is also female, that is why is this group is different than the CEO is the male, loan officer male, or there is no difference. I think I will, since I have it looks like there is a quite nice large data set that available, I can exhaust it or I can explore different probability to different level, just without touching the theory. Possibly, yes, we can explanation after you get result. Then you need to explain this thing. If there is a difference, why is different? If there is no difference, why not difference? So that's what this is my sort of immediate sort of if this data is mine or if I am then I will go for that type of additional exploration to data. That's it. But I'm enjoying nevertheless I'm enjoying the result and I'm enjoying the presentation. Let's continue.
No, that's fine. I mean, that's really interesting. But we'll give us a thought, on what you are saying. Actually. Okay, go ahead, Ong.
No, I just want you to continue, please. Yeah.
Okay. Yeah, okay. But the discussion is very interesting. Yeah. The discussion is interesting. And then because people can just take, the papers on their own and read it, but we really, okay. Okay, thank you very much. And then basically, as I was saying, right, well, there have been studies suggesting that on average, women are more risk-averse, more compliant with rules, and more ethically driven by men, actually. Then we can think that if there are female loan officers, more female loan officers, and so on, then they will adhere much more to the rules, they will align more to the letter of the law, and then also probably, even if they are managers dictating them what to do, maybe they will be much more unwilling to do that if they think that this one does not really go with the rule, actually. Okay? Well, and at the same time also, there are theories saying that, well, basically, if you are men in institutions and so on, we see the critical mass theory of counter, right? They can really get some positive result if they have a critical mass of them. If you look at the literature will say female representation has to be about 35% to really them starting have a positive, a significant impact, actually. Then we take that also, actually, and then say, okay, basically, probably there is also a threshold effect, actually, right? Then this is what we want to look at also. Then the second hypothesis for us is basically that the MFI, which employ a higher proportion of female loan officers, may be less exposed to the risk associated with related lending. Then we see our second hypothesis. Then you see the first hypothesis we motivated with literature review was basically related lending has a negative impact. And the second hypothesis is that if there is a critical mass of women, actually, loan officers within the microfinance institutions, then this can have a mitigating effect on that of the relationship between related lending and portfolio quality. This is basically, these are the two hypotheses we'll be looking at, actually. Then to go ahead, the data we are using, we use microfinance and information exchange database, which goes from 1999 to 2019, actually, with almost 3,000 individual microfinance institutions who report, to that database, actually. And then we have about, 20,000, approximately 20,000, observations. And then when we clean up the data somehow, because Some years do not have many observations. For example, 2019 had only 2 observations. Then we drop that year, actually. Then we go further, and then before 2004, actually, we didn't have information on loan officers, characteristic, on the board structure, and so on. Then basically, we dropped that, the years from 1999 to 2003. Okay, then the sample is restricted to 2004 to 2018, actually. And then also the measure for us for the portfolio quality is the loan portfolio at risk 30 days, actually. Then when we actually look at that also, and then we control for outliers, when we control for outliers, then the sample size decreases, a lot, to 30,600. And then that some of the variables do not have the data for everything. Actually, then when some of the variables are included, then it reduces again, the sample size. That's why in some of the table, you will see the sample size will be reduced a lot from the initial, approximately 20,000, actually. Then we explain all those details in the paper, okay? Then basically to do that, what type of econometric model, will be testing? Basically, on the left-hand side, the Y here is the loan portfolio quality, which we measure by the portfolio at risk at 30 days, okay, the PAR 30. And then on the right-hand side, our key variables, explanatory variable will be related lending, and then I will explain shortly. Related lending are measured in two ways. There is a dummy, whether the microfinance institution has any related lending that will be 1 or 0. And then another measure of related lending will be the proportion of related lending in the total amount of lending, then the ratio, actually. They do the same thing for female officers. Whether the institution had any female loan officer, then we use a dummy. And then also, we use also the variable of the ratio, the number of female loan officer on the total loan officer, actually, the ratio. Then we use both measures, actually. And then to capture the mitigating effect of female loan officer, you see, we put the cross product of the two variables, actually, to see whether it has any mitigating impact. And then we have our control variables. Usually in this microfinance literature, we have control variable for the MFIs, and also we have control variable for the country, actually, right? And then we have this kind of setting. And then the estimation strategy we are using for the baseline, we will run panel random effect estimation. And why is that? Because we have some random dummy variables, and then we thought that, the random effect estimation was much better than the fixed effect, actually. And then because there is the issue of endogeneity, right? Because someone can ask, there's issue of endogeneity between, those variables, then we try to deal with endogeneity. First of all, we use the lack of explanatory variables in our regressions, to mitigate some of those reverse causality issues. But we go further, and then for robustness, we use, this non-parametric instrumental variable approach proposed by Bretung and all, and also we use the approach proposed by Yang and all as well. Okay, and also we use the extended regression models, actually, with endogenic covariates as well. Okay, as further robustness check, actually, for the endogeneity issues, the possible endogeneity issue. There are also selection bias, because you can say that maybe the related lending, decision is not exogenous. Also, the female loan officers as well, actually. Then basically, we have a sample selection bias, because then we actually also, use, the entropy balancing technique, to be able to deal with all these selection bias, issue as well, okay? And then we further, go to correct some of the selection bias, actually, because some of the MFI, because you see this mixed database have self-reporting, then the microfinance institution choose to report it. And then maybe some of them are not reporting as well information on related lending as well. Then if we go on to that, in terms of really selection bias or coming from misreporting, then basically on this mixed database, the quality of the information is captured by the diamonds, right? Then we use, real microfinance institution with higher diamond. That means that the information usually are audited by audit, I mean, companies and so on, so on. Then the quality is much better. Then we restrict the sample to those MFI as well. And also we can have also someone can ask about basically the country effect actually, because these are not same jurisdiction, because these are really microfinance coming all over the world actually. Then we control also for fixed effect from year or country fixed effect actually, and then we believe that those country fixed effects actually capture some of the jurisdictional, I mean, differences among those institutions. Yes, you have your end.
Is the on your model, if I am correctly understood, that you are looking at the value at risk at 30 days.
Yes, that's right. Yeah, yeah. They portfolio at risk at 30 days. Yeah, yeah.
Do you have a supporting information that is the maturity of the loans, overall maturity of loans? And then I'm expecting this financial, even a microfinance, their loan maturity should be more than a year. And minimum, I mean, on average, generally more than a year. At the 30 days, portfolio is for me a bit very, very short period.
Yeah, okay.
But I might be misunderstood. I mean, the things is in concept, but 30 days value looking at the value at risk is it could be a bit. This is not a sort of interbank or more wholesale market. These are the very, very, I mean, bread and butter institution, very locally, and they are. It could be more than a year. Okay.
Yeah. Yeah, you see, I mean, on this table here, the first line shows you the way this loan portfolio, I mean, portfolio at risk 30 days is measured, actually. You see, these are outstanding balance on the areas over 30 days, total gross outstanding, refinance, and so on, over total gross portfolio. It's not value at risk, actually. But basically, it's really very common that in this microfinance literature, people use portfolio at least 30 days, because usually those microfinance loans are very short loans. Actually, if you look at most of the portfolio, the loans are very short maturity. But beside that, we as robustness, we also did actually the portfolio at least 90 days. Actually, we also did for the 90 days actually, 90 days at risk also. We did that. We also use the matrix of the write-off matrix, and also we use the loan loss provision, actually measures as well, to actually as alternative measure of loan portfolio quality actually. Right?
You don't have the maturity, I mean, on average maturity of the loans. And if that is if you show the statistics on that, then I am quite happy, because it's what you claim, what you suggested, what you are, that could be yes, makes sense for me. But my expectation, I mean, just without knowing the data set, my expectation is this the microfinance, it should be even the personal loans, it will be more than 30 days. 30 days. I don't know. Maybe it's
Désiré, do you know, do we have a maturity of the loans? I mean, on the database?
I'm not sure, but I will check. I mean, if the information is available, at least we'll report the average loan maturity as you suggested. But I'm not sure that we have. Again, it's bank balance sheet. I mean, MFA balance sheet, so it's probably it won't be available. But I will check the database.
Yeah, we'll check. But I think, I mean, these loans are very short term. I mean, loans actually. But we'll check. I mean, that's a good point. Let's check. I mean, actually, yeah. Yeah. Okay. Then basically, these are some of the variables. I mean, actually, as I told you that, I mean, basically, related lending, we have the ratios and we have the dummy. And female loan officer, female loan officer as well, gender diversity. I mean, we're female loan officer. We also use the percentage, and also we use, the dummy actually to do the analysis. Okay, basically, just some of the split 30, but let's move to the result actually.
Can we
Yes.
just 2 seconds more? I want to see the size of the MFE or MFI organization.
Yeah,
is the average size, which is okay. It's the 2.5.
Yeah, but these are number of offices. Log of a number of offices. Yeah.
Yeah, is the total asset? Is it the total asset?
We are the total asset as well. We have information on the total asset actually. Yeah, I think we even run the regression with the total asset as well, but we prefer the total size. Also the log of the number of offices, but we have information on the total asset as well. Yeah.
Yeah, we do have the information. Actually, our first variable to measure size was the number of offices in log, but we use also as a robustness the size in terms of total asset. It doesn't change. But I can just go through the statistic and
I just my initial my own curiosity, because it's the I say if it's this big size office, that means it's the bigger the number of the offices, then could be the big size of the MFI as well.
Yeah, because most of the time, in this microfinance literature, people use both actually, and looks like also the number of offices is a good measure also of the size of the MFI. Because basically, you see the type of institution they are, they try to reach as many people as they can, and so on. That's why this idea of number of offices sometimes is used as a measure of size as well. Yeah. Right, that's with the statistics, and then we have other numbers here, but anyway, okay. Yeah, then if I come back to the result here, right? Basically you see the first one here, 1, 2, and 3 have a regression with basically using female loan officers and also related lending dummies, right? Then we use dummies actually. Basically what that means is if the MFI had any related lending, then it will be 1, right? If it had any female officer, it will be 1, right? Basically. And then to see the impact of that, if the MFI is practicing any type of related lending, does that have any impact on the quality of its portfolio? That will be the first regression here. And then the second one will be the size now of the really related lending. Then the ratio, the size of the related lending on the total loan portfolio, the impact of that on the portfolio quality. And then you see on both windows, we have a really strong positive impact of related lending on the quality of the portfolio. The same thing for the female loan officer. Then when we have female loan officers, either they are present or more female loan officers, that one seems to be improving the portfolio quality somehow. But you see the mediating effect, the cross product, even if it's negative, but doesn't seem to be significant. But I will get to that. I will get to the critical mass story soon, actually. Right? Then this is basically the first result we are getting here. Okay. Well, then you see this first line here is confirming our first hypothesis, actually. Well, then we say, okay, because we have a combination, right? Female loan officer combined with related lending, what the marginal effect, actually, of related lending depending on the female loan officer, right? Then we do that marginal analysis. Then you see, as the number of female loan officer increases, you see the marginal impact of related lending actually on your portfolio quality decreases actually, right? Then there seems to be some type of female officers at critical mass impact actually. It's almost like 30% of critical mass seems to have impact here, right? And then we push that further actually. Okay, then we look at the test size. Yeah, we divided the sample into in terms of 3 test size. The first test size MFIs with no female loan officers. Because some MFI have no female loan officers. They report having no female loan officers. The second test size have female loan officers around 10% of the officers are female loan officers. And then you see the third test size are female loan officers around 53% on average. Okay. Then we run the regression with these three test size. Actually, if there is any critical mass effect, then we should see actually the impact as we move to the higher tercile. We should see some significant impact there. Right? And then this is what we do. Because on the first one, there is no female loan officer. Then we don't have to run the regression for that to see the mitigating effect of female loan officer. Then we run the regression with the two last tercile, the second tercile and the third tercile. And this is what we do. When we do that, basically, you see on the second tercile, because the female loan officer are on average 10%, we don't see any significant impact. I'm talking about the cross product here. But when we go on the third tercile, then you see really we have a significant impact of the cross product of related lending and formal loan officer. Looks like when the women they reach some level, certain critical mass level, they are starting to have a really big impact on the mitigating impact on really this negative impact of related lending. I mean, this is basically, then this is kind of confirming our second hypothesis here, okay? Well, because there are all this issue of endogeneity, selection bias, and so on. Then we run further robustness analysis and so on. Well, we use, this of Bretung et al. And Yang et al. Analysis, but just for the first part, this is the hypothesis one. We run it, and then you see it's confirming again our result actually here. With these two techniques, Bretung et al. And Yang et al. Actually. We also, we use the extending regression models. It's confirmed also our result here, right? When we use the extending regression models, it has all this variance and correlation data and so on. But I just cut them for the sake of the presentation, but all this can be found on the paper and so on. Then that one, you see the extending regression models also is in line with the baseline results actually, right? It's here. Well, we even go further, for the selection bias, actually, we say, okay, basically, let's, try to test on the selection bias, issue here. Then we use the entropy balancing technique, actually, where, the treatment variable is lending to related parties. The first one, this is the panel one. We do that. Again, you can see that our results still valid here, okay? Whether we the weighting list square or the fixed effects. We also do that with panel B, where the treatment variable is the presence of female loan officers. We do that again, still, the results still, valid here. Okay. We also, as I told you, that because these are microfinance across the world, actually, then someone can say, oh, well, if you go to Asia or you come to Africa, depending on specific country, the jurisdictional, it's not the same. Some countries have stronger rules than others, and so in terms of regulation and so on. Well, the way for us to control that will be basically to have a country fixed effect, right? If we have a country fixed effect, then those jurisdictional differences to be captured somehow by those country, the country, by this country fixed effect. Yeah, Tululu, yeah. But,
yeah, I wonder why you are not interacting the female officer ratio.
Yes.
If the story is that of moderating effect, because that is what you started on, and you had some contradictory results until you got to the critical mass story. But the analysis that followed, I suppose you should have interacted the female officer ratio with the related lending ratio to continue with the moderating effect story.
Okay. Yeah, that's so. Yeah. And when I was preparing, actually the slide, I realized that we run those ratios. I agree with you because basically we should have run probably this tensile regressions with those robustness analysis actually. But you see, we actually what we did is this table here, the ratio part, we run the same regression with the robustness we did actually, not on the tensile actually. That's why you see the interacting term you see is not coming out actually. Because here, before we run to the tensile, it wasn't coming out actually. But when we went to the tensile, then it's coming out. Probably the robustness, actually, we should also continue the robustness also as well on these two tests. We haven't done that yet at Tululo, actually, but we'll do that. When I was preparing the slide, I just realized that actually we haven't run those ones actually. To be sure that the tensile story still, old actually. But I'm pretty sure it will old, but we have to do that,
Thank you.
Yeah, okay, thank you. Yeah, but this one, the whole sample actually, that's why the interacting effect, you are not seeing them coming strongly actually. Yeah. Okay, then we do the standard regressions. As I said, the entropy balancing technique, we for the linking to related party at treatment variables with the presence of female loan officer at as treatment variables. And then you can see, especially the hypothesis one, still old, in each one of those regressions. But to come back to the point of Tululu, actually, for the hypothesis 2, we have to run it also on the tensile, actually. We haven't done that yet, but this is something, we'll be doing right after this, right after today, yeah. Okay, then we also, as I said, control for the country effect because the jurisdictional differences and so on, then that one also should be controlled for that. And you see, still the hypothesis 1 still hold actually when we do that. Okay. And then, as I said, because reporting related lending, because on this database we mix one is self-reporting. Maybe some microfinance are not reporting, right? Then what we did basically, we say, okay, those who are reporting, can we really select those who are high quality information reporting? And then the way we mix database, capture that is by the diamonds. Then the 5 and 4 diamonds are the one with audited financial statement and so on. Then we believe that if they are audited, then the quality should be somewhat better than those who are not audited. Then we restrict the sample to those audited one. Actually, these are the 4 and 5 diamonds, actually. And then we run also the analysis, same result for our hypothesis 1 as well, actually, as you can see, okay? Well, and then because in terms of our sample, actually, we also run it, but start the sample in 2008, actually, and onward, actually. And then again, same type of result. We find it here. Okay. Then this leads me to conclude. Basically on what we have done. Basically, we don't know that microfinance institutions basically. One of the goals is actually to reach the bank actually. Then people who are not really served by the banking system actually, then they will be trying to reach the poor and so on. And then this is a social mission for them. And then this is almost like the double bottom line, right? Objective of the microfinance. Well, to be able to reach, those banks, these are the social finance, one of the objectives actually. In doing that, sometimes they will lend to related parties, right, which are shareholder, directors, and so officers and family members or companies which are affiliated to those people actually. And then the aim for us was to evaluate the impact of related party lending on the vulnerability of those microfinance institutions. And then we measure really the portfolio quality by the portfolio at risk 30 days actually. And as I say, we did also robustness for other measure of portfolio quality measure, and then still the results still hold actually. We use those sample of microfinance institutions from the mixed database covering from 2004 to 2018 actually to run our regression. And then the result is basically related lending has a negative impact on portfolio quality. and then to have a mitigating effect from female loan officer, those female loan officers have to reach a critical mass. And in our case, the critical mass here is 53% actually. Then beyond that, we are starting to have a mitigating effect actually. And then we did a lot of robustness check to control for endogeneity issues and also selection bias, as well as the quality of reporting, and also controlling your fixed effect of the country fixed effect to control some of the jurisdictional differences actually, right? Of course, well, we have really, I think, we have contribution here because basically, although the issue of related lending is very important, we think that this is the first time, to study really the impact of related lending on portfolio quality in the microfinance context, actually. Then, for that, we have, really a contribution, actually. And then, the second one, we thought, is a contribution is to bring in the gender issue actually in this relationship. Actually, these are really, and then in that sense, we complement some of the existing work or existing on this issue actually. Of course, we have limitation in our study, right? Some of the limitations actually is the mixed database itself, right? We use because the mixed database are self-reporting, right? Well, they are not random. Okay, then this is really a issue, a challenge actually. Another one also actually is basically the MFI choose whether to disclose information on related lending or not to disclose it. The same thing for gender also variable as well actually. These are some of the limitation of our study. We try as much as possible to really control for some of those issues as we can actually, but we do actually recognize that there are still be some of the limitation of the study actually. Okay, in that really thank you very much for listening to the presentation. Right, and then I can stop it here and then take your comments, suggestions. And as I said, this is basically a new paper, and then we are working on it. Any comments, suggestions will be very welcome actually, as it will help us really improve the paper for the next step actually. Thank you very much. I will stop my.
Thank you very much. I do not need to say, but it's very good presentation. It contains the motivation, the underlying literature and theories, and you did well in explaining the econometric process. So we have a question here, Andy. Hi, Andy.
Hello, Hong.
Hi, Andy. Good to see you.
Hi, Andy.
Nice study, Issouf. Well done. Just a comment and just a couple of comments really. I wanted to hear more about the magnitudes of the effects. You're focusing a lot on what's significant and so on, but you're not focusing very much on how big these effects are. How big are the effects of related lending, and how big are the effects of having the females or not? And the second concern was the thing you said right at the end about it being self-reported, the case of related lending being self-reported. There's all kinds of selectivity concerns that raises. How many people do self-report? How many people don't self-report? Are there patterns in who self-reports and so on? I think you need to investigate that and explore that. Thank you.
Yeah, thank you very much, Andy. These are really good point for a very great point actually, right? Yeah, the magnitude of the impact. Especially the economic magnitude. Probably we can even calculate that. To put down the paper, but tell you that related lending, if you look at the percentage of the related lending itself on the total portfolio of the microfinance, it's not big at all.
Okay.
If I look at the descriptive statistic, it's not huge actually. I think it's something. It should be something less than 10%, even much lower than that actually.
Okay.
But although the percentage is not that big, still, it has a huge agency problem actually. right?
Yeah.
Actually. Okay, but the economic significance of bringing women and so on, I got you, we got you. Then we'll calculate that also, probably report that on the paper. Then I think that will actually would add value actually. Thank you very much. But for the self-reporting, I completely agree with you, and Andrew, right? Because I don't know what we can do about that, right? Because these are really the database there. We just use that database try to do things with actually, and we do not microfinance are the one reporting it, and that's why actually we did additional robustness with the quality of information, because in that database you see there is a classification of microfinance depending on the quality of the reporting by diamonds. Then when you use the fourth and fifth diamond, these are the microfinance institutions which actually have audited, financial statements. That it means that the financial statement you are seeing are audited. Then we can take that as kind of quality of reporting, right? And then that's why we restrict the sample to those one and then run the regression on those one as well, actually. I know it doesn't mitigate the whole thing, but somehow this is what we did.
Thank you. Thank you.
Great. Good questions and responses. So I see Jeffrey's hand here. Jeffrey, can you come in, please?
Yeah, thank you. And thank you, Issouf, for your presentation. I just want to say something regarding the limitation that you mentioned at the concluding part of the study, and which is also what the last person just said something about, because I think the issue of regulation and reporting are important in this very study, because that is what differentiates microfinance institutions from the traditional banks, is how much they are regulated. And we've seen so many rules being introduced in many countries in recent years to try and regulate microfinance institutions. But there's one study that I would like you to look at, which may address the study that you, the problem that you just mentioned. This is a study by Djerry in 2021, where they investigate the when in Bosnia and Herzegovina, the government asked microfinance institutions to start reporting to the banking regulator through the former credit registry. So what they discovered in that study, that from the time they introduced that, asking them to start regulating through credit registry, the financial microfinance institutions, their portfolio changed immediately from for existing borrowers or the subsequent borrowers, because they have to adjust the entire portfolio because they now have a mandatory reporting system. So you may want to consider such reporting system. Maybe that will and see if the number of countries in your sample, because I understand you have international sample. So the number of countries that have introduced such schemes, and see the impact of that, because that has been found to be very effective in addressing the issue of self-reporting. Thank you.
Yeah, and also, Jeffrey, if you can put that the name of the author, on the chat, it will be very. Yeah, we'll copy it. That will be.
Yeah, I'll send it to you.
Okay, great. Yeah, thank you very much. Thank you very much for this comment. Actually, yeah, exactly. We try to the regulation. Actually, I think we have a variable on regulation. Actually, on the explanatory variable, but also with these differences in terms of jurisdiction across country, we try to control for it by putting, like actual fixed effect, counter fixed effect also. But I will look at this paper you are referring to and see really what we can take it from. Thank you very much. Yeah.
Okay, great, well done. And do we have more hands or questions here? Okay. So yeah. So maybe I have one more question, and that is about the mechanisms, the channels through which those women loan officers can mitigate the negative impact of related loans on portfolio performance. So that's interesting. But based on what we have already seen in the existing literature, what is the channel here? So why do women loan officers can reduce the negative impact of related loans?
Yeah. Yes. Okay. Thank you, On, for receiving that. This is basically what I was motivating. I mean, in the literature review section, actually. Basically, if you look at, I mean, what he said about the women, basically, is that usually they are more risk averse, they are more integral, they are more, they abide more to the rules actually, and so on. Then basically, you see, because these loans, the big problem with these loans, because it's coming from sometimes from your CEO. You are a loan officer, your CEO asks you to do something, even if you don't agree, more likely you will agree with it. But the literature will show that the women, because I'm actually the career concern, it's very difficult for them to get up to the top. And then when they have those positions, they prefer to abide to the rules, actually, instead of contrary to the men, actually, who probably will accept much more this kind of pressure than them, actually. And then because they are risk averse and so on, then they are much more effective in terms of monitoring those loans, actually. That's why, I mean, it has all this mitigating effect on this, in terms of the performance, actually.
Mm. Yeah, so yeah, maybe what you have mentioned are all they make sense. But I would think deeper about what is the literature or the theory that we can justify this. But maybe that's the next one, and maybe that's something that referee is going to ask about when you put your paper into the review process. So in fact, we have another hand, and TANDJA, welcome.
Hi, Issouf. Thanks for the interesting presentation. Just a quick one. Is there any possibility to include a variable that captures the educational level of the female officers?
Okay. We check, I mean, if we have that information particularly. Education level, okay. Because, I mean, what you had in mind, then they will be more effective in terms of monitoring, they are more educating, right?
Yeah, perhaps something along those lines, yes.
Yeah, we check, I mean, I'm not sure but we check. I'm not sure we'll have this information on the database specifically. I mean, in terms of really, because you see, I mean, as we female loan officer, the way we are doing it, I mean, we are aggregating, I mean, actually. But I don't know if we have information specifically to the female loan officer to look at how many of them have reached a certain education level and so on. But Désiré, yeah, because Désiré is, I mean,
no, we don't.
Yeah.
We don't.
Yeah.
This aggregated information database, so we don't have such detailed information.
Yeah.
Oh, thank you.
Okay, so that's good, and the math theory. So since you highlighted the threshold, so when the proportion of women officers is above 50% of all loan officers, and you see the result. So I think this is an opportunity that you add the math, the theory. I saw some theory, so you can enhance the theoretical background to justify, to support the empirical analysis.
Okay.
So do we have more questions?
I think this would be a minor one.
Yeah. Okay.
I don't know if you have variable that can control for audit quality or compliance quality.
Yeah. I mean, basically, what we did, as I said, we didn't put a variable, specifically in the regression itself, for audit quality, but what we did, we restrict instead the sample to the microfinance institutions which are actually seen as having better financial statements. And that comes from the audit actually, because on the mixed database, they make the classification depending on the information quality. And then those with 4 diamond and 5 diamond are the one which actually have a financial statement audited by sometimes by the Big Four actually. Right? Then we took that as a sign of quality of a financial statement actually. And then we run the regression with that group. I don't know if that controls some of what you are mentioning actually.
Yeah. To some extent, thank you.
Yes, thank you. And Issouf, I think we had a very good session today, and particularly in terms of the quality of the discussion. And this is how we learn from each other and from the papers, and great stuff. So I want to thank everybody who contributed to the audience, to the questions, discussion. Issouf, before I conclude the session, I know it looked like you enjoyed very much.
Yeah.
So, one sentence or two to conclude this. Yeah.
Yeah, thank you very much. To everyone for this great comment. As I say, this is really, we are just working on this paper. We are trying to finish it actually to send out to journals. And then those comments are great actually. It helps us really, go back and then improve some of the area we didn't see actually. Thank you very much, for those comments, very helpful comment actually, very appreciative. Always a great pleasure, to be here at this seminar. Thank you very much.
Of course, you're part of our network at CGF. So thank you very much, everybody. Thanks for your time, and let's keep in touch. If you have any questions, you can always communicate with Issouf. And I'm sure he is going to respond. He's that type of person. So thank you very much, and enjoy the rest of the day. I will see you next week.